Hi, everyone. This is John Pokerobe. It's May 28th, 2022. Just want to wish everybody a happy Memorial Day weekend, but it's time for a market update. So as a reminder, I'm an amateur individual growth stock investor, and I'm not affiliated with IBD or MarketSmith. And this presentation is made by Rain King LLC. Before we launch in, I wanted to remind people, if you haven't heard, our annual Blue Sky Investing event has been scheduled for this year. It's going to be Saturday, all-day event done virtually, so everyone can participate. October 15th is the date. We have a tremendous group of speakers, as you can see on the screen. Scott O'Neill will be with us, Mark Minervini will be with us, Oliver Kell, Ryan Pierpont, Matt Caruso, Brian Shannon, and Jared Tendler. A great group of people, and as we get closer, we'll give you more information. Sign up won't start until after Labor Day. So the quick agenda is the big picture, few internals, talk about the psychology of bear markets, and then we're going to spend the most time looking at market bottoms and how new leadership emerges, as well as we'll go over a few specific names showing positive action. So the big picture, I'm going to use this monthly chart. I've shown it before. Last talk, I talked about the upper trend line showed a low of about 11,000 in the NASDAQ, which would be normal. The lower band and lower trend channel was around 10,000. And we seem to have been testing both of those areas right now. So we're right in the zone where the market is going to hold, or we might go deeper. So quick look at the internals. 2 weeks ago, May 15th, we looked at the new lows on the NYSE. And at the time, we said didn't look too good. The new lows were actually confirming new lows in the index. Not a great picture, but the picture has changed dramatically in 2 weeks. This is the same chart of the new lows on the NASDAQ, excuse me, the NYSE. And you'll notice that as we form the new low on the index and we start to make this rally attempt, the new lows have dried up dramatically on the NYSE. So that's a very, very positive development that we're seeing there. So that's good news. Now, I showed these two charts 2 weeks ago. The top chart is the all equity put to call ratio. And, it's moved up, but it really is not reached fear and panic levels that you usually see at market bottoms. Also, the VIX has come down in recent weeks. Again, the VIX has not really spiked to a level that you would see at market bottoms. So, we might still get a retest of the recent lows, and we may even undercut those, creating more fear and panic in the market that would be needed to form a durable market bottom. Also, growth stocks, are usually set up and lead in a new bull market, and growth stocks are not really set up yet, in my opinion. And I'm going to go into this and spend quite a bit of time on it later in the video. So let's talk a little bit about the psychology of bear markets in general. And I've drawn this very diagrammatic move. Usually the first leg down in a bear market, the initial decline can be gradual, and it's viewed as a correction. And people kind of have the buy the dip mentality because you've been in a bull market up until that point. So most investors in this period are actually looking to buy the dip. When we get our second leg down in a bear market, we have a rally, which we had a very sharp rally in March, and that first rally will fail, and it did fail. And all of a sudden the decline accelerates, happens very quickly and sharply. And this is the point in leg two where people have real concern. They're probably stuck with losses because if they were buying the dip and maybe buying this rally and didn't sell, they probably have some deep losses. And their quote unquote, their psychology is they're actually hoping for a rally because they've been damaged in leg two. And now what happens in leg three is if this next rally were to fail, everybody would kind of see it. It becomes obvious that the market is going lower at that point, and everybody sees that we're going to decline deeper. And that's when people really start to panic about the market, and they throw in the towel and they sell everything. They just get rid of all their stocks. And that's usually when you'll get a market bottom. So if we look at that in relation to the current market, This is the NASDAQ as of Thursday. And, I've shown that the first leg down in this bear market, the leg was about 22.5% deep, and it occurred over 15 weeks, fairly gradual, though it felt pretty dramatic. But the second leg, after we had this very sharp counter trend rally, leg two we've come down 24.7%, and it only took 7 weeks. Faster decline in less time. This gets people's attention. So there's two legs down in the market, the way I'm analyzing it. Now, many of you might say, well, geez, John, you could look at it this way. And when it's absolutely a fair assessment, you might look at leg one from here to here. You may look at this counter trend rally and say leg two was from here to here. And then you might see this as leg three down in the bear market. That's definitely a fair way to look at it. I subscribe to the black lines that we've had two legs down, but it's everybody has their own opinion on how to interpret it. I think it's very important to watch this next rally. Maybe we recover in a very sharp rally up into the 50-day into some of this overhead supply, which we want to watch closely. And we want to see if we're going to hold and digest the gain, or we reverse and get another sharp leg lower, which could be leg number three down. I tweeted this out on May 23rd that I had said that, we still could get a failure of the rally and get a panic flush down to 3,400 in the S&P 500. And the NASDAQ still could come back and test the 10,005 to 10,000 level. The 10,000 level in the NASDAQ would be a pretty good level as a psychological bottom for the market. Again, this is the 2018 bottom where we saw capitulation panic selling. You'll notice pretty distinctly, one leg down, a counter trend rally, a second leg down, another counter trend rally that reached into resistance. And then we had this real flush and we had climactic selling. We have not seen really climactic selling in fear, as I mentioned, with the put to call and the VIX. So I still have my concerns about how far we can go with this rally, but we need to be open to both sides. So let's look at some market bottoms and the formation of new leadership. And this is really important because we want to talk about what are we looking for to see if we've got a bottom and we have a new bull market, and what will be the leaders. So as perspective, this is a chart out of a model book that I did. This just shows the NASDAQ composite from 2012 to 2020. And I've marked some of the bear markets in 2015, 2018, and the COVID bear market. And you'll notice I put the follow through day, and I've also located the breakouts for major winning stocks. And you'll notice that the cluster of the major winners occurs in the first 12, 13, 14 weeks off the follow through day. Lots of leaders emerge there, and you'll see these clusters of stocks. And you'll even go back here to the 2012 intermediate low when we finally got some follow through and a lot of big leaders emerged. So we keep that in our heads. Big leaders emerge early off the bottom in the market on a follow through day. So let's go back and examine the 2003 bottom. And it was a long protracted bear market from 2000 to 2003. This chart here is the NASDAQ composite, which ground its way lower and lower. Now, I wanted to pull up Dick's Sporting Goods for a number of reasons. One, Dick's Sporting Goods was an IPO that occurred in October of 2002. Generally, you will see IPOs that make their public offerings during a bear market. They usually are quality companies that are coming forward. A lot of people pull their IPOs during bear markets because they can't get enough liquidity and interest from investors. So I pay attention to IPOs during bear markets. Dick's Sporting Goods, actually came out. It actually had a move up, and it formed this double bottom. And you'll notice that the market was making new lows. And eventually we got the March 03 follow through day, and Dick's broke out of a base and went sideways. And then eventually, as the follow through day got some traction, Dick's took off. And if it's important here on the right, you can see the double bottom. And actually the stock breaks out a couple of weeks. This is a daily chart before the follow through day. And you'll notice that as the market made a new low right here, DIX went sideways essentially and held its pivot point, and then it really took off. So the two elements I want to stress is DIX had a prior uptrend of at least 25 to 30%, and then a double bottom quality base. Now DIX went on to make a 209% move after the follow through day. Now let's look at the 2016 bottom. This is coherent. And again, the NASDAQ is in orange. As the NASDAQ comes down and makes a new low at this point, you can see that coherent makes a new low. Okay, so those are totally in synchronization, but coherent is starting to form a base. Now the market tried to move up, came back down, and in the green bubble, the market makes a new low, but you'll notice that coherent actually broke out with some very, very big volume. And on the pullback to the new low, you can see the new low in coherent is way, way above the previous low. This is a divergence, a positive divergence when the market makes a new low, but the stock doesn't make a new low. We want to pay attention to those. Another one from 2016 bottom was Green Dot. You'll notice that it was forming actually a double bottom base. Again, the first low, Green Dot made a new low. You can see that Green Dot broke out of this double bottom base and it actually got pulled in a bit. But the important thing to note from the chart reading is this low is substantially above the previous low in Green Dot. That type of relative strength is what we want to line up the indexes versus an individual stock. This chart is the S&P 500 from the bear market in 79 through 82. So the market bottomed in August of 1982. So I wanted to show a couple stocks and what they look like going into that bottom. The first one is Walmart. Now the market made 3 new lows. This is the S&P. You can see the first low, we noticed that Walmart had been moving up. It had a prior uptrend and moved sideways. Got pulled in a little bit with the market. So we have a new low in the market and we have Walmart making a low. Then the market comes down and makes low number 2. But if you notice, the Walmart does not put in a new low. It's actually holding above the previous low. That's showing relative strength. And Walmart actually made a move up and formed a cup with handle base. This is a weekly chart and it breaks out. The market came down and formed its third low in early August. And you'll notice that it pulled the Walmart breakout, pulled it right back in. But when the market pressure came off, you can see August 82 is the follow through day. Walmart had already taken off. It was already showing that it wanted to be one of the big leaders. And it went on to make a 230% move. The other one, again, is an IPO that occurred before the bottom in the market. This is Home Depot. No one knew of what Home Depot was going to become when it became a public company in October of 1981. You'll notice that we have a prior uptrend, and as the market came down and made a low, this is low number 2 on the NASDAQ, you'll notice that Home Depot actually breaks out. So that is a significant positive divergence. Now the market between low number 2 and low number 3 is grinding down. Meanwhile, Home Depot is grinding its way higher and we see blue spikes in volume, very positive, showing relative strength. Then as the market comes off low number 3, we finally get the August follow through day. And you can notice as the pressure comes off the market, Home Depot is off to the races with a significant advance. So the point of showing you these particular bottoms and a couple of the new leaders is I want to make the point that the next new bull market will be led by new growth names and innovative leaders that are showing earnings and sales. So it's a good time, in my opinion, to start looking at running screens against recent IPOs. Look at the 2019, 20, 21, and 22 IPOs and look for stocks that can show some characteristics with earnings and sales because they could become the new leaders of the next bull. Now, the other really important point I want to make is every one of these stocks had a prior uptrend of 25 to 30%, and then it formed a proper base showing accumulation. This is a really important critical characteristic. So the accumulation signs might be seeing big blue spikes with above average volume. You might see tight weeks, 2-3 tight weeks in the base, multiple up weeks in a row, blue weeks, and the volatility will get tighter. The lower volatility, tighter ranges. Very important characteristic to try and pick up on the charts. And we notice by looking at these particular ones from history that the relative strength of the stock started to reveal itself before the index followed through, or it happened exactly when the market was following through. So the astute investor with good chart reading skills is picking this up because they're running their screens every week and looking at their charts. The point of this is avoid bottom fishing and trying to pick off the former leaders that are just coming off the absolute low and you're trying to pick the bottom. That's not a good technique. You're much better looking at a stock that forms a prior uptrend and then a proper base showing accumulation. So where are we? Well, we've been looking for a follow-through day and we got the follow-through day late last week. Now, it's important to look at the quality of that follow-through day. And some of the characteristics we want to look at are, what was the percent gain? Well, it was almost 2.7%. That's a positive. That's a really good gain. What did the volume look like? Well, we had higher volume than the previous day, but the volume was below average. It's about 9% below average. So that's really kind of neutral, in my opinion. It's okay, but it's not super strong. And the most important question is, are there stocks that are breaking out of quality, proper bases? Now, the energy sector has seemed to have renewed its strength. It had based for a period of time. So oil, natural gas, and the coal names look like they want to move higher. And some of them are breaking out to new highs. So that's a plus if you're putting them on your watch list to play the energy sector. But in the sense of, there are very few growth stocks that are actually set up in bases. Many of them, as I mentioned, are coming off the ultimate lows that they've had, and they don't have proper bases. That's a negative. Now, new bull markets, as we've been looking at some of the historical cases, we usually will see growth names and they'll be in quality bases with a prior uptrend. So, we still need to take this follow-through day at face value. And we want to get some exposure in case this follow-through day leads us to new high ground. We don't know. So some exposure to me means somewhere into 15 to 30% of your portfolio, and you'll see if you get some traction. And if you do get traction, maybe you can put some more money to work. Now, you certainly could put money into some of the energy names that we told you were strong and re-energizing their uptrends. Now, if there are no individual growth names, then you might consider buying an index or an ETF like the Qs to get some exposure to some of the growth areas as a group. Now, I want to talk about what names do I see in the growth sector that are showing positive action. So here's a few symbols that I think are showing positive constructive action. DigitalOcean, Halo, DLO, 4, NVIDIA, NetScout, Celsius, and Tesla. Now, the important thing I want to mention is these are not buyable yet. And you may say, well, why aren't they buyable? Well, it's because of our criteria. And we've studied the previous gross winners at market bottoms. And are these stocks showing those characteristics? And again, as a refresher, those characteristics are, is there a prior uptrend in place of 25 to 30% minimum, and then a proper base showing accumulation with the 4 following characteristics? And are they showing relative strength versus the indexes on the charts? So, a good trader anticipates what the chart could become. And you have to also be flexible enough to change your mind if your interpretation doesn't work out. So I'm going to take one specific stock on this list and really do a deeper dive to show you what I'm seeing and why this stock is of interest to me. So the stock that I'm going to use as an example is DigitalOcean, DOCN. Now, to put it in context, DigitalOcean has had a very severe decline on the weekly chart. It's a 77% decline. Now, if we were to look at this low on the daily chart, This is where I want to get really detailed. This is where your chart reading skills are really important. Now, you can see above here, this is the NASDAQ composite. The NASDAQ makes a new low, and DigitalOcean has made a new low. Now, the index makes a little bit of a rally attempt, and you see DigitalOcean rallied. Now, as the index pulls back, as I've shown here in this pink line, pulls back pretty sharply, what does DigitalOcean do? This is really important. The stock holds its gains and goes sideways. Look at those tightness of those closes, and the stock moves up again and goes sideways. And look at the blue spikes on that chart. Those are institutional investors. So this is a very positive divergence that's starting to materialize. Now the NASDAQ made another new low, but you'll notice that DigitalOcean has made higher lows. And again, this is totally off the script, as I showed you those stocks, the 03 bottom, the 2016 bottom. So those are things we want to pay attention to. This is a positive divergence, no new low in DigitalOcean. Again, look what we have here. We have a prior uptrend of 66%, really good move in the stock. But we want to anticipate how might this play out, because we still need a proper base, a minimum of 5 weeks, probably 6, 7 or longer number of weeks. And so if I were to just kind of anticipate this and say, well, the stock has made a nice move, might pull in and form a base, perhaps a cup with handle. We know a proper cup with handle takes at least 7 weeks. So if you just look at the calendar, 6 or 7 weeks from now is going to bring us to, July, late July, even August, before we get the characteristics that we see in the big winners. So I would potentially see this, but I'm flexible enough to say, it's possible we don't form a base and the stock moves straight higher, but this could happen and could be very, very positive. The other thing that's really positive with this stock, it's a recent IPO from 2021. And you can see this is a real company with real earnings and real sales. And you'll notice that the estimates for 2022 and 2023 are very positive, over 90% growth and over 70% growth. So these are a lot of the characteristics that we look for, and you should be looking for in screening against young IPO companies to try and find these types of setups. We know these are the setups that work, and don't overlook the prior uptrend. You must have that to really assure you that you have a stock that's being accumulated and forms a proper base. And then we get a strong breakout from that base. We certainly are seeing some great accumulation signs here with big blue spikes, tight closes, and you'll also know that this is the 10-day moving average and the 20-day. The stock is starting to respect those moving averages, which is another positive development. Not to me, the stock is not buyable now, as I'm a position trader, and I want to see the stock further set up, but it's on my watch list. So that's all the time we have for now. Hopefully there's some important things here for you to look at when you're looking for things for your watch list. You can join me on my Twitter page, as well as subscribe to my YouTube channel. Thanks, everyone. We'll see you at the next market update.